Inflation is coming down, but stubbornly. Economists see the chance of some level of recession increasing. Could that be a good thing? Low unemployment and low consumer confidence don't usually happen at the same time, but inflation dynamics partly explain why that's happening now. Cash and crypto both showed unusual risks at different ends of the spectrum. Who's to blame for that? That and more coming up. Welcome to the Quarterly Context webinar for the first quarter of 2023 for clients and friends of the advisory group. I'm Greg Patterson, CEO. The advisory group is a wealth and life strategy firm focused on helping business owners and leaders with their goals and financial stewardship for themselves and their families, their fiduciary role with employee retirement plans, and their communities through the endowments they work with. To complement the strategic goal work we do with clients, Quarterly Context webinars are designed to make economic and other information approachable, and high-level perspective regarding the economy, markets, and investor behavior patterns are what we provide to help clients stay more relaxed by being more informed about what matters towards making better decisions towards your goals. We try to keep it to around 20 minutes or a little bit more than that, and we'll also circulate a video link should you like to pass it on to someone else. If you think you know someone that we can help, like we've helped you. And if you have any questions, please submit them to the question box and we'll either answer those as we go along or at the end. So we'll cover a number of things today, including as always, patterns that matter. Rates and inflation are a current topic, and recession-related elements, and the cash and crypto risks that we mentioned just a moment ago. As always, we like to remind everyone to focus on that space that matters most, which is that space between things that matter and the things you can control. You can't control markets. You can't control how you respond to them. And of course, the things that matter are oftentimes clearer. The overall pattern of this last quarter was a little bit volatile, given some increased uncertainty about what's happening with inflation, what's happening with rates, and there were a number of what many would consider to be sort of negative news items here, with the one of the worst weeks in the S&P for the year, persistent inflation concerns. It's been coming down, but not coming down as fast as the Fed and the public would like. A big drop in the Dow at one point related to interest rate concerns, which relate back to the need for the Fed to control inflation. The Silicon Valley Bank fell apart and imploded and was shut down. And then despite that, the Fed boosted rates. But with all of that negative news, we still ended up with a strong quarter for stocks. So it's a great reminder that negative news is not always a reason to panic. And one of the reasons that it did notch up is that the response by the Fed and by other private entities and banks in response to, for example, the Silicon Valley Bank situation did increase confidence and decrease the concern about a bigger contagion in that regard. There was a small interest rate increase, as mentioned, in the middle of March. The overall inflation has continued to come down, was ratcheting down more slowly and then sped up a little bit, but still some concerns about persistence. The overall stock and bond markets were both positive, actually looking a lot more like expected returns than they have in a long time. If we were to convert this quarter to a year, but these are quarter numbers, which means that would annualize out to even stronger numbers. Unemployment hovering around 50-year lows at 3.6, and GDP is hovering around the estimate, although the projections, as we'll talk about in a moment, are a little bit lower for the coming year or so. And in terms of value versus growth, whereas value was significantly ahead in the last quarter, that reversed this quarter and growth had a big jump. Overall, for now 2 quarters in a row, stocks and bonds have been quite strong. Not yet erasing the weak 2022, but helping wear that negative number down. As you can see, if you look out farther, returns are fairly solid and reasonable, although still very weak over medium to long term in terms of bonds and a couple of isolated asset classes that have been out of favor. If we take a look, a bit of a look back at 2022 and take a 60-40 portfolio mix in the top here, looking at just the two indexes, and then the bottom looking at a sample portfolio, what we noticed that is interesting is that because of the rising rates having such a negative impact on bonds, it really hurt diversification in 2022. Bonds did not provide the cushion that they normally do, but having the most rapid and significant rise in increases ever in a short period of time can have an impact on both stocks and bonds. So for 2022, a 60-40 portfolio was down 17%. If we look back to the global financial crisis, which was the second worst stock market ever, it was down 26. So it's interesting that even though the stock market was closer to being the 10th worst in 2022, the overall portfolios may have ended up being, maybe the second or third worst for a 60-40 ever because of that again, weak bond returns. So about a 9% difference here, which is significant. But if you think of the magnitude of the 2008 stock market, it's surprising or interesting to see that the difference in 60-40s were not actually highly dramatic. We can see the stock market was twice as worse in 2008 than 2022, or more than that. And the bond market was much, much better, positive return, providing some diversification, again, which highlights why the differences here are not as big as you might have expected. The good news is, after a quarter or two of stronger equity returns and now some stronger bond yields coming out, all of a sudden that what was a tough year for stocks and for bonds in 2022, that's being whittled away in terms of the current one-year return ending March 31st. All of a sudden, this looks like, wait, hey, 3 years, that's above long-term averages significantly for a 60-40. Above average for the quarter, and not a highly unusual one-year return. That can happen on occasion. If we look out farther, 10 years, again, just a reminder that the average returns for stocks in the last 10 years are right on track, in some cases above average, in some cases a little bit below average. But despite COVID and despite this interest rate jump, longer term returns, medium to long returns are right on track. So that can provide some little bit of solace for those that are feeling a little bit nervous about what markets have done in the last couple of years. Similar chart to what we've shown in the past here. You can see a long-term average projection rate of return here, starting the global financial crisis. So we look forward in this big ramp up when there was $5 trillion in stimulus in the economy. That really boosted stock returns and boosted earnings. You can see the earnings numbers were also up. But it's normal that once something gets a little higher than usual, it might cool back. And actually, both earnings and stock prices are really more in line with where they should have been. So it's never comfortable, but sometimes people forget that an excessive rise relative to averages oftentimes is followed by some cooling. And so maybe we're closer to where we should be. On that note, stock valuations with the last strong quarter or so are up a little bit above the averages, but still hovering not too far from the 25-year average. That's the broad U.S. stock market in terms of large companies, S&P 500. If we look at small cap versus large cap and mid cap, small and mid cap are still relatively undervalued versus the history in most cases, except for mid cap growth, whereas large companies, especially large cap growth companies, are relatively overvalued. So this is a great example or case for diversification. You don't know when each asset class or sub-asset class will do well, but it's important to keep exposure to them all, especially the ones that have been undervalued, because those tends to bounce back and work their way back towards normal over time. 2022 and part of 2022 is actually exhibited that where growth was out of favor, value started coming back into favor and provided some diversification. Similarly, growth versus value is shown here. You can see value stocks, those that are essentially undervalued relative to what might consider their intrinsic value or some other kind of measure, are relatively more attractive, where growth is relatively less attractive because of their prices. Again, this doesn't mean we would dump growth, or anyone should. It just means it's important to keep the discipline, keep rebalancing, and to benefit from the cycles as they shift. So how about talk of recession? The talk of it was fading a little bit, talk of a slow session. Now an increasing number of economists believe there'll be some level of recession, or maybe kind of flattish growth. The March estimate for 2023, looking out for the full year, is less than 1%. So that represents some cooling, not negative growth, but approaching a recessionary environment, depending on how you measure that. Similarly, but not quite as low, global economies, or the globe in general, GDP or growth estimates dropped 50% down to 1.7%. And that's the weakest, one of the weakest in the last 30 years. So a global slowdown, not surprising given how many countries around the world have ratcheted up rates to try and rein in what has really been a global inflationary rise. If we look at the rates that have been ratcheted up by the US Federal Reserve, as well as other central banks, to try and control that inflation, after such a long period of near 0% interest rates, you can see it's really getting back to normal. What's interesting, this theme now overlaps with the Silicon Valley banking crisis and collapse, with credit tightening at the bank level. That is a bit like the Fed rising rates. It's harder to get credit. It's a little bit more expensive because of the perceived risk of the banks, and the banks in terms of who they're willing to lend to. And that is actually allowing the Fed to back off on their plans to rise rates a little bit, because functionally the banking sector is doing that for the Fed indirectly. Also looking at rates, same pattern here, different time period, but this shows the projection of the Fed in blue and the broader market in green in terms of where rates will go. So the Fed expects to raise rates a little bit and then expects to see them cool down. The market doesn't see the raise built in, may be a little more concerned about a recession, and may think that some kind of stimulative rate cutting to lower the cost of capital would happen sooner and then flatten out. And again, here well, not again, but the long-term expected sort of equilibrium rate is around 2.5%. That talk of some increased chance of at least a mild recession is reflected here in the yield curve when it's inverted like this, where short-term bonds have higher yields than long-term bonds. And you see this blue line was the previous quarter, gray line is the current quarter, shifted down a little bit, stayed the same really at the short end, but lower as you go out farther in terms of longer-term bonds. That is a sign that the bond market feels there's a greater chance of some kind of recession. Inflation, which the rates are intending to control, which is leading to the concern of the of recession, has, as mentioned, cooled down to about 5% annualized, and you can see also wage. Well, actually, this is just the inflation information. So cooling, but not quite as fast as some would like to see, and therefore the continued talk of potentially rising rates before they start coming down again. Unemployment and wages. Here we can see unemployment continues to hover around that 3.5, 3.6 level. Wage gains did occur for a while and then now have cooled off as the economy is cooling a little bit in response to that rate activity. And this brings us to one of the reasons consumer sentiment is low with inflation being persistent. It's an interesting combination of low unemployment, but also low confidence in the economy for the average person. So normally when there's low unemployment, people are feeling relatively confident because more people have jobs, more people have incomes, more to spend, and so forth. What's happening now, however, is that, well, if we look back to this chart, wage gains have improved somewhat. They still, on a real basis, have not caught up or have had slower gains than what might be more typical in history. So people may, and the average person may have been a little bit more on the edge financially. And then inflation happens, and inflation is going up more than their income. And a lot of people are having to make hard choices. Their savings, as you can see here, the average personal savings rate has come down significantly, and the excess savings pool out there overall has gradually diminished. That's putting stress on people. More people hear about making significant incremental changes in their basic shopping behaviors in terms of what type of groceries they buy, especially within the lower economic strata, and that's essentially the primary driver regarding why sentiment is low despite unemployment still being relatively very good shape. Volatility remains at slightly elevated levels relative to the last few years, but not near the COVID spike level. The COVID numbers are continuing to cool in terms of number of deaths and the number of cases. However, it's come to the point now where the government sort of tried to make an official statement about the crisis being over. And one of the key sources of data for capturing and charting all of this information has been Johns Hopkins University. And they have indicated they are going to stop collecting that data. So this may be the last time we see this chart unless there's some other new data source. But this hopefully coincides with COVID becoming more like a regular flu symptom that would be incorporated into regular multivalent vaccines, and therefore more of a normal and manageable virus like a lot of other flu type viruses. So maybe goodbye to this chart. We talked last quarter about the cryptocurrency dynamics of the last few years and how that compared in a lot of ways to investor mania and the tulip mania of the 1600s in the Netherlands. If you didn't hear that, take a peek on our blog at the past quarterly context webinar. Some interesting charts and data you might find interesting there. But what we want to bring crypto back into the conversation because there's been significant risks at the two ends of the spectrum. One, crypto is a little more understandable. Everybody now has a better perception of how speculative it was. In the case of FTX, there was also mismanagement and fraud. The price has fallen almost to, approaching zero, have gone bankrupt, weren't yet public, but we're talking really about the price of the currency, which relates to the confidence of that organization, the cryptocurrency. And so excessive overconfidence and excitement and sort of investor mania in FTX and other cryptocurrencies, which have subsequently, in many cases, fallen apart. Cash is at the other end of the spectrum. This relates to the Silicon Valley Bank collapse, and there were other banks that struggled, most of which have sort of been pulling through due to acquisition from other companies or government support. But this is an interesting dynamic because there are some unique characteristics about Silicon Valley Bank that led to this problem. Silicon Valley Bank had far more and much higher magnitude balances sitting in basic FDIC type insured accounts, way above the FDIC $250,000 limit. So that magnified investor or saver balance holder panic once there was concern about some of the risk of the underlying deposits at the bank, which relate to essentially management buying long bonds. And then, as we talked about earlier, rates go up, long bonds drop in value. the longer the bond, the more the drops in value, and that led to people being concerned about whether or not they could make good on the savings accounts, which led to a run on the bank, and social media rapidly circulated that news amongst the investors, depositors at Silicon Valley Bank, which led to one of the most rapid runs on a bank, or the most rapid run on a bank ever. And that led to a collapse. Now, the government has stepped in to help backstop that, to help people make good on their accounts, but it's a good reminder that cash isn't always safe. If you have significant amounts of money above the FDIC limits, it's important to find a way to diversify that. There are also much better paying vehicles that are still cash or cash-like, such as money market funds. And if you've got much more cash than 250,000, if it's not for a specific plan, there may be an even better use for it, so that you're not losing against inflation. So those are questions to discuss with your advisor. But all of this really paints an interesting picture of big risk at two ends of the spectrum, and the ultimate reason, if we were to boil it down, is really to the behavior of the investors and deposit holders. At the banks, people didn't really understand or think about or consider the highly concentrated similar nature of the startup type individuals and companies. And so they were all extra panicked when there became a concern. So it's important to understand your bank a little bit and make sure they have diversified depositor base. In terms of, but then ultimately it was that if there wasn't a run on the bank, Silicon Valley Bank would have had time to sort of gradually solve that problem, but the run on the bank caused it to collapse. So that's fear and panic leading to actually increasing people's own risk. But that's a human dynamic. Crypto, similar, caught up in the hype, overlooked management because of the excitement and the possibility, but the fundamentals weren't there, and there was bad actors, and it all fell apart. So the big moral of the story is, don't overconcentrate, don't get overexcited, be effective in due diligence or having someone help you with due diligence, and be disciplined where it's important. And if you've got a well-built, diversified portfolio, discipline means usually hanging on, but in general, shouldn't get overexposed to things that have the excessive risk, as we've talked about just now. We have a webinar coming up in May. The announcement will be coming out. You should get an invitation if you're on our mailing list. It relates to helping accomplished women better understand how to empower themselves around their money decisions. And I think you'll find that very interesting. So if you are a woman in that situation, or know one, or have a daughter, aunt, wife, or friend that you feel would benefit from having a good, smart financial framework for improving their lives, this is a good webinar to pass on to them. We have a few blog posts recently on that women and money topic. Also some general elements regarding the Secure Act and the savings limits and other factors there, which are also relevant to 401k and other retirement plan fiduciaries, and a set of questions that could help you ask the right questions and change your life and financial independence. If you're already a client of ours, a lot of those questions should already be addressed, but it's always good to take a peek and see if there's something you thought was addressed that now something has shifted in your life that would lead to a new conversation around one of those topics. So we're glad you are here today with us. We hope you, if you have any questions, maybe start plugging those into the question box. And if you know others that we can help like we've helped you, please pass on the advisory group's contact information. It's a delight to work with you and to help people that you care about, helping people or their communities or their employees get to a better place with smart financial decisions, education, and guidance. And lastly, I'll just mention that we do have an additional set of charts that some of you may have grown accustomed to in the past. If you'd like to run us through some more micro level details on some things or other data sets, please let us know. And we'd be happy to run through that with you individually.